Hi, everybody. Welcome to another edition of Beyond the Bank. My name is Andrew Orbach. I am delighted to welcome Michael Nairne to the podcast. I'm going to just read a little bit of Michael's background, and then we'll jump into what will be, I can guarantee you, an insightful conversation. A slight editorial. I worked for Michael in 2000, very early in my leadership career. I was an eager 32-year-old and just learned a ton, a real visionary leader in wealth management. So let me read a little bit about Michael and we'll jump in. So he, of course, as I've just mentioned, brings extensive investment experience to Tacita Capital, as well as Canadian and U.S. business experience. Michael has always taken an integrated approach to wealth management, incorporating client goals, balance sheet, risk tolerance, tax, an area that I'm sure is going to come up in our conversation. Family office clients benefit from his very unique and in-depth understanding of complex wealth management issues, as well as his knowledge of alternative investments, real estate, and private equity, in addition, of course, to more traditional investments. Prior to co-founding Tacita Capital, Michael was the chief operating officer of Loring Ward Inc., which was a family office based in New York and Los Angeles. Michael was also a co-founder and the vice chairman of Asante Corporation, Loring Ward's original parent company. During his tenure, Asante grew from $1 billion in AUA to over $20 billion, including $8 billion in leading tax-managed asset allocation strategies. A little bit of background on Michael's education. He is, without question, an expert in the field. He's a chartered financial analyst charter holder. He's a member of the CFA Institute and the Toronto CFA Society, a registered financial planner, a certified financial planner, and he graduated first in his class in Canada as a chartered financial planner. Also the gold medalist in his graduating year from the Honors Commerce program at the University of Manitoba. So without further ado, Michael, welcome.
I'm very glad to be here.
Well, that's great. I am looking forward to this conversation very much. And before we jump into a whole bunch of different topics, I'm wondering if you wouldn't mind just taking us through a little bit of your perspectives on your career journey as an entrepreneur in wealth management. You know, you've been a pioneer in financial planning, as I mentioned earlier, but you've had a very unique and interesting career trajectory. I'm sure people would love to hear about.
Well, it's I'm glad you asked the question because in like contemplating, my response, I really began to see how my career has kind of interacted with all the major evolutions in the industry.
Mm-hmm.
So, I go back to a time when the start of the 1980s when PEs were 8, not 28, as we're looking at the States today. If you look at your histories, the 70s was very unkind to stocks and bonds. They got decimated by high inflation, the energy crisis, the problems with poor monetary policy. So when I came into the industry in 1980, it was at a moment of transformation where Volcker actually took on inflation and won through high interest rates. Reagan brought, capital-friendly policies to the fore. Equities just took off. I mean, from a 8 PE, there's only one way they could go. And that really created the impetus for the mutual fund industry to begin to form and accelerate. A couple other things occurred during that industry. It was like today, the start of the 80s was high tax. So there was a tendency, I got my chartered financial planner before I got my, my CFA designation. So you came at it really from all investing involved tax because your client might have a 65% marginal tax rate, which is, I think a world we're going back into. And then the pivotal study, you'll know this from your knowledge of finance history, was in '86 when Brinson's asset class study came out. Now, there's debates about it and variation, et cetera. But it underscored the importance, if you're going to have a long-term plan, you start with your asset class composition. So our firm, Equion, which myself and my partners, we really bought out the people out west, and we joined the TSX, and we required people to get their CFPs. We did a lot of things, but we also adopted that as the key planning. So when you sat down with the client in '86, we were doing asset mixed charts 10 years before they became popularized in the industry. And we actually, by '98, took on the moniker Wealth Creation, Preservation, and Management, Equion. So, and because interest rates were falling, people were sitting on GICs at 12%, were being renewed at 7%, 6%. And this whole area, the whole industry, was one of moving people towards balanced portfolios. It was really quite exciting. You know, I joked people today in those days, the industry grew in 3 years, but it grows 10 years now, right? It was, so the second phase really of my career, we'd grown to over $1 billion, and I met a chap by the name of Marty Weinberg, who has really had pioneered some leading tax-sensitive asset allocation products, multiple asset class, did all the software, years ahead of his time. And he had an investment counseling firm in Winnipeg, which I'm from originally, so I didn't view that as a negative. He was looking for strategic alliances and people who could use his product. And he actually came to Toronto looking around. A lot of people said, "Oh, this stuff's too fancy." Well, I met him. I thought this is the product of the future. And it was my colleagues and partners and I, and Marty he was the chief shareholder. We merged to create Asante in the early 90s, I forget when, 94. And that was really an era of consolidation because at that time, growth in the industry was slowing down and the banks were moving into funds. And it was very clear that you needed scale. So all these firms that had grown in the 80s, Financial Concept Group, DPM, if you ever read the Asante, I'll get into that in a minute, going public, it's the list of all these financial planning firms that we acquired, and really was part of how do we compete against the banks? How do we get scale? How do we systematize this? So that was kind of the next epic period. The next period in my career really was when CI bought Asante in 2003, Donnelly Mutual Fund Company. They were looking to move into wealth management, integrated distribution. And that all of a sudden, after 23 years, starting with Equion, you're like, I'm free. Well, we didn't sell the US part to the States. And I've been asked the question, if you're planning strategically in Canada, what's the most important thing you should do? And I always say, get a plane ticket to the US and see what's happening, because that's where we are. They'll be 5 to 10 years ahead of us. So, so we had not sold the US part, and we actually had acquired some business management, turnkey asset management firms. And when I began working down there in New York and LA, it was very clear, a very different model. It's registered investment advisors, open architecture, so they use all the products that are available. They're fiduciaries, so they're not in an agency relationship. They're like a lawyer or an accountant. They're a position of higher trust with the client. They are client-centric. And by being open architecture, they can use anybody's products. It's the opposite of the proprietary model. And when you take a look, that's as close as you can get to being on the side of the table with your client. So my wife, who's was a top tax lawyer in Canada, decided after 25 years to leave law, and we actually entertained moving to the States. But being analytics, we were like, well, what's our social capital and our professional capital down there? Well, a lot less than in Canada, plus Canada's a great place. So we decided to set up Tacita Capital here to manage our family's capital and the capital of others. But again, based on this model of client-centric, independent, open architecture, fiduciary, and then critically wealth management, not just investment management. And that was the genesis of Tacita Capital in 2005. We took our first client in 2007. Not an auspicious start because the great financial crisis occurred like a year after we took our first client. I can give you a quick story on that, though, which is kind of interesting. And that was really the start. And we've grown by referral, really. You might call it the ultra high net worth space, high net worth, whatever it is. Very much focused on this idea of bringing integrated advanced portfolio management and wealth management to affluent families. And it's a great business because I've been in two public companies. So one was Loring Ward, the other was Asante. When you're sitting on the board there, you got to worry about the shareholder, you got to worry about the client. Which hat are you wearing? They're not always fully aligned, at least in the short term, on fees or that. So great to be in this business, managing our family's capital and that of others. As you know, it's called a multifamily office, which really is where there's a founding family with their own capital, and other families then invest with customized strategies, but are investing on a platform. A little different than, a commercial business where the people setting it up may, don't have the same amount of personal capital and, invested as a client.
What an amazing journey, Michael. Thank you for that. I've got about 5 follow-ons to build on it. One of your, I would say, very unique qualities is such an accomplished and visionary track record, but also such a modesty. You've always struck me as somebody who would much rather keep their head down and think about our industry than promote yourself. And it's pretty remarkable what you've been able to accomplish with that mindset. How'd you get into the business? You're such an analytical person. You think deeply on issues. Was it something you sort of said always, I want to be in this industry, or how did you find your way here?
No, actually, I came in first is my favorite subjects in high school are history and math. Now think of that, history and math. Like, that's not a normal combo, but it is a great combo if you want to be in the financial industry, right? Because there's so many lessons in history, but it's still ultimately a quantitative. I mean, the guts and bolts of portfolio creation, and that has got a high quant element. But no, I actually graduated in marketing, went with Procter & Gamble. I was in brand management. And found out great company, great people, great training, but found I didn't like a big company and left to join a firm called Laventhal and Horwath and Management Consulting. But their focus was actually feasibility and financial analysis for hospitality and real estate, hotels, shopping center, and beginning working there. And they were also a very entrepreneurial firm, and they were involved in creating real estate syndications. And so I got into that, and they asked me to be president of their company they were setting up in 1980, I believe, Realco Securities, which focused on real estate. Now, again, it sounds funny now, but that was the product, and that was the era. And real estate had tax benefits. But when I left them to go with Equion, it was really apparent you had to broaden, rapidly became apparent you had to move to a much broader platform. But the marriage of math and history has kept this very exciting and entertaining, and it's ever changing, and it's the nexus. People's capital, their dreams for the future, what they want for their family is intimately related with, and the management of it means you're dealing with the global business cycle, the local business, the monetary cycle, interest rate cycle, product evolutions, regulatory. So, if you don't like change, you shouldn't be in this industry, because to be a really good practitioner, you're staying up to date. Every budget brings change, right? For example, on the tax side, which has ramifications for products, which has ramifications by client because they have different tax profiles. So if you like complexity and change, it's a great industry.
To your point of integration as well, we talked about this earlier. I also did my chartered financial planner many, many, many years ago, and that had a very strong tax focus. I mentioned to you, you walk into the final exam with basically that big green tax book of about 3,000 pages. And thankfully it's open book. Thankfully it was an open book exam, but you could get lost. You could get lost in there. But I'd love to hear your perspective. This is something, to your point, of the intersection of disciplines, how we tend to underestimate the impact of tax in a private client context as it relates to wealth management. So we'd love just to get your perspectives on that, particularly with wealthier clients.
So, and I've been at every facet of the industry. And even today, we take on clients because we take on multiple generations. So, we actually have an RESP, evolving model portfolio as a family gets older, as the kids get older.
Yeah.
So so we deal with the small accounts that are building capital because we're dealing with the kids, that their needs are very different than their parents or grandparents who are highly taxed. It's, in a lump sum sense, it's the single biggest expense they have. And it's got a lot worse. If you look at the history since the current federal government came in, it's been one tax increase, tax on split income rules, capital gain inclusion lift, really penalize it. So if you don't really marry your investment planning to the after tax realities of each client, you're doing them a big disservice. And that varies. In New Brunswick, for example, they've got very low eligible dividend tax rates. So that client actually may have a need for slightly more Canadian equity than somebody sitting in Ontario. So when we build our models, we build them on portfolio optimization, risk return trade-off matrix. But then we also run them after tax. Now, you still put risk constraints around it and those kind of things, but it will end up moving them towards a slightly different mix. And then when we build the products, our product selection has a huge focus on knowing the tax consequence of vehicles. I'll give you an example of how this works. In our optimization work, as interest rates fell and you're doing a 10 or 15 year asset mix, because asset mixes are built on a strategic basis first. As interest rates fell, it was very clear that risk was rising. A duration of 8, I'm earning 2%. What's that all about? But even an optimizer would say, I want less of that. Well, I want more defensive hedge funds. Well, a lot of hedge funds are very highly tax effective because the long side is treated on capital gain. The short side is often deducted on income accounts, so it's a bigger write-off. So, again, building a model, taxable clients will want more of that. And again, our rules are risk management first, but right behind that is after tax optimization. And I was in looking at Morningstar, which one of the big analytic tools is, and they have an after tax computation that you can compare. But when it's kind of secondary to the pre-tax, where really it should be primary for large tax, anybody who's meaningful tax situation. And then number two, it should be a tool where you can optimize relative to maybe a New Brunswick client who's at 150 grand income versus Alberta client who's earning 500 grand. And then superimposed on that, you always have the corporation, which adds another whole layer of complexity. So I think that's one of the biggest changes coming. In fact, I'd heard that the securities commissions, when they did the updated KYC rules, had looked at requiring tax information. Remember, they now require balance sheet information. It's a much more fulsome KYC. And the investment industry pushed back. It's like, what? Tax information? That's the accountant's role. And I'm like, well, no, it's the accountant is critical, but he should be working with the wealth manager as a team. And then the wealth manager on the portfolio side should have this. In fact, if you go to our website, we talk, that one of our specialties. We call it investment tax planning because that's, that's our drill down. We're not doing, we're not doing a freeze or whatever, some of the work the accountant does, although we're involved again on the consultation and have a role and all.
Michael, in terms of the families you're dealing with, let's say ultra high net worth families. Let's talk about a family that sells a business. That's often what's happening in Canada. All of a sudden, they have a significant liquidity event through the sale of the business, and they now have a meaningful sum of money. Let's say all of a sudden this family that never considered themselves wealthy per se, they had a comfortable lifestyle, They now have $50 million. Puzzling as to what is different and what is the same. How do you find families address some of these issues, and what are the issues that families you find are facing as they come into very significant liquidity events?
Well, it depends on where they're at, because if they're selling a business at, let's say, 150, 200 million, they actually have an option to set up their own single family office. When they sell the business, they often bring their, accounting team with them and that. So that group we've found, and we work with a family like that who set up a single family office, but they've outsourced the investable asset piece because they want to put their energy into their new entrepreneurial endeavors, where, of course, the targeted return on private business might be, 15 to 20% return. Well, how much capital are you doing there? Obviously higher risk, illiquidity, all those things. But so, and then how much goes into that investable pot? And that's always, one of the big discussions. The second element you get pulled into right away is, if they haven't done one, should we be doing an estate freeze? Because we see time and time again people buy insurance without analyzing, well, you're going to do an estate freeze because I'm going to freeze it when I'm 75. I don't need as much insurance if I let the thing run. The financial planning software usually it runs it till you die, and then here's the insurance you need. Well, when you have huge amounts of wealth, the insurance amounts can become pretty, don't get me wrong, insurance is a key part, but if we're freezing here, then maybe I don't need as much. So again, you get into that. The third element is the concern is very much often with the kids, because a lot of hardworking entrepreneurial families, they're not living the opulent lifestyle because they're, busy with their business. I mean, they got a nice home, kids might go to a nice school and that, but they're not wandering around saying, look, I'm worth $100 million. Now all of a sudden they got liquid wealth. They don't want it to spoil their kids or grandkids. So that becomes a huge area. How do they become capable stewards of wealth? Our model is built around the entire family. Of course, it's the choice of the client becoming clients. So we have 4 generations, because we've got, the 90s, the 60s, the late 20s, and then the RESP for the 1-year-old. And our next generation of wealth managers who are, 35 to 40 are working with that generation and their kids on their own strategies with, by the way, a Chinese wall. It's their capital. What are they doing? But it's the same requirements. What are the long-term goals? Where am I going? How am I saving? How do I build a well-diversified strategy? How do I make use of the tax pieces? What are the other elements that I need in insurance? So I think that family model, the multi-generational family model, is an ascendant model for doing the best for these families. And what starts at the $25 million family, 5 years later, the $5 million family is doing it. So I think we're going to see, you'll see those evolutions. I mean,
yeah.
So that's one direction. And there's a lot of other changes. Obviously, privates have come in, the role of hedge funds. Like there's a ton occurring on the product side all the time. At the same time, there's a ton occurring on the on the tax side and the pension side. And that the other one is the families are dealing with is multi-country residencies. So, we've seen families, unfortunately, where the kids have bought a lot, have bought some substantial insurance when they're younger, and the parent did it as part of, an estate plan, a multi-generation transfer. No one said, hey, if your kid moves to the States permanently, that's no longer insurance in the eyes of the states. So big complexity. So, you get involved in all those ones. Where we saw one family where the insurance had to be wound up. And then the other one is you go down there and the PFIC rules, in terms of if somebody retains their Canadian as a U.S. citizen, they've got real investment restrictions in Canada. So we actually have US estate exposed, PFIC exposed models that are just for people with that issue, because there's, you get that. So this high level of complexity sets in. But that's really, what you're there for, to meet the needs of every individual client.
And taking that family approach you've described, I mean, the reality is there just isn't one playbook, and there isn't one right or wrong answer as to what the family priorities actually are, and the attitudes about wealth and the concerns about, children's values around money and all these things. To your point, there really isn't a playbook. It's really around kind of understanding what the family wants to achieve and then doing a lot of work to figure out how to optimize what those objectives
Yes.
are.
How to optimize it exactly is the case, right? But it's clearly the best way to go, because you're for that family. But it's not, from a business perspective, it's not easy to do, because you're, with the compliance requirements and fiduciary requirements and, KYC. If you've got three people of a younger generation with very few assets, and you're taking them on, and they're on a family pricing schedule, right? So that they're obviously, the whole family's assets are being based on AUM. Then you've got to be in it for the long run, which we are. So it's not a problem.
So that takes me to you're uniquely qualified to kind of opine on this one. You had mentioned earlier that look to the US as a bit of a leading indicator on trends to come to Canada. You said, maybe they're 5 to 10 years ahead. As it relates to RIA, maybe they're 20 years ahead as we think about, 20,000 firms or some such number in the US, and, a very, very small number in Canada of investment counseling firms. Certainly contrasted, let's say, 350 firms across the country, a number like that. Why do you think this is? Why do we have such a concentration? One, obviously the banks have, let's say, 85% of the share. But given, what you've described as all pretty compelling reasons to see more independent firms, a fiduciary standard, conflict free, the conflict of accountability to a shareholder versus a client with often differing priorities as to what the shareholder is looking for relative to what the client priorities are. So what is your take on this, having run businesses in the US and Canada? Just the big why. Why are we so slow to see more boutique firms?
Well, I think one is the sheer legacy, size, and trust factor Canadian banks have. We can't underestimate that. Yeah. So that it gives people a really warm comfort, because they've grown up with those brands on the street corner. So that's number one. Number two is just the evolution of the industry. There used to be banks, brokers, and trust companies. And then the banks bought all the big brokerage firms. I'm talking, Burns Fry and the like. And then they looked around and said, well, now we're going to buy the trust companies, Royal Trust. Right?
Exactly.
So they bought all that, and then they went, well, now we got to start buying the big investment management firms. So their business models have taken them, and we end up with the oligarchy that we have. I mean, they're very well run, they're well capitalized, but they are ultimately face conflict of interest, in terms of they've chosen, most of them, because it's the route to profit maximization, to maximize proprietary product to the extent they can. And some of that product's good, some of it isn't. So again, you've got a conflict of interest. But notwithstanding that, it's, that marketing reach and that comfort factor. The second thing is we don't have enough custodians and platforms. There's not in the States. There's plug and play in a number of places. So I can get together as a RIA, which is our discretionary portfolio manager. That's the registered investment advisor down there. I had that designation out of LA, when I worked in California and New York. So the you're able to really get into the business with 3 or 4 people can get together. And the banks there's many, no, there's giant banks, but there's many more banks, and they just have not had the reach and domination. And all of a sudden, at one point, you got Schwab providing a back office tailored for RIAs. You've got TD when they were down there before they sold to Schwab. You've got Pershing. You've got Fidelity into that business in a major ways. And then you have all the software, where a lot of software choices, and integrated software. I mean, we're in Canada, we don't have the choice of custodians, and we don't have the choice of systems. So it's all impediment. And then it's harder to get your license here in Canada. In the States, they evolved a different way. You write I forget which one it was, series whatever exam, and you pass that, and you can become a discretionary portfolio manager on approval. When I got my CFA and was in California, I just put the papers in, I got it. I didn't have to write anything. So, that's a faster way of getting into the industry than today. And, the regulators have just concerns about quality of people and everything, but, it does create a barrier to entry. And, the result is it's harder to get together. And I think, I think Brad Dunkley over at Wartaw said, when he 10, 15 years ago, you set up your own firm, you could do it, with $100 million. And it's like, now you need $400 million. But I understand, like people like Purpose, there's new platforms becoming available.
Correct. Yes.
So the more we can get platforms, the more we can get a group of independent fiduciary discretionary managers out arguing the case. And the case is compelling. It's also compelling on a product side, because biggest change in the investment industry dealing with I hate to call it retail versus institutional, but the retail market, including the individual market, is the creation and growth of the ETFs. You go back to 1985. I want an advisor and I want a good manager, and then I've got the cost of the fund and the shareholder register. I'm at 2.5%. Right now, you can get the wealth manager, let's say, for 1% a year, and I'm just rounding off, and they can implement a portfolio. And let's leave hedge funds and alternatives aside. They have their own merits and detractions and challenges and utility, but they can do a complete portfolio for 25 beeps, let's say. So I'm on a 1.25 versus 30 years ago. I have half my cost to the client. So that's another support for the independent, because I don't need proprietary product. All that product is sitting on a publicly available shelf, highly transparent, a lot of different information systems that become very sophisticated. Some of it is broad market. Others pursue very, what's called factor strategies. Some have tax advantages. We found some of them. You go into the States, they are now allowing, and we have them here, actively managed ETFs. So there's a whole choice exploding there. So that's transformative and is supportive of the reemergence of more independent wealth managers, portfolio managers working with individuals. So I'm kind of hopeful that we see a renaissance of that, because I think, look, all competition's healthy.
Exactly.
You get out of bed with that Darwinian reality. So more competition for the banks is good for them, and more choice for the consumer is good for the consumer. And
I think to your point, I think that is really well said, that, having the banks are exceptionally well run. I was in one for a long time, but there are those inherent conflicts when ultimately the objective is to sell house products as much as you can, whether that's mortgages or loans or bank accounts or term deposits or asset management. And the consequence, unfortunately, as you describe, the US revolution related to ETFs, it has been so slow in Canada from a penetration point of view, because of course the banks still continue to sell their actively managed products in their bank branches. And as a consequence, to your point about, the lack of competition, we're paying probably double the MERs right now of the US. Of course, they're a much larger market, et cetera, with more scale, but still not to that kind of, to that. The education of the benefits of what a boutique firm can actually do from a fiduciary context, as you've just articulated it so well, you don't need to manufacture the product when you've got that breadth of, such unique slices on the ETFs now. Really, any way you want to go, you can pretty well get it done, whether it's active or passive or hedged or any of those other aspects to it. It takes me to the question about the industry. I know you've got a couple of kids that are in the industry. As people enter today, would you say this is an industry that has as much opportunity as we had during our career starting? Is there more opportunity in the future? What's your view of the next decade in wealth management?
Well, it's a different opportunity, and it's an opportunity actually that requires more education, training, breadth of vision, multiple designation. If you look at our firm, I mean, my wife, who's co-founder, is a tax lawyer. As a CFP, CFA. Our other partner who joined us, Garnett Henderson, joined us early as a partner in the firm, is CA, CFA. And then we have, MBA, CIM, we have CFA, we've got Chartered Investment Alternative. So you really, from day one here, have to be, in my view, the world of tomorrow requires dual designation. You can't just get your CFP. It's not enough in a world where you've really got to understand more complex products, even like liquid alts or these evergreen. They bring unique risks in. Volatility is no longer really a good measure of risk, which we'll see the commissions dealing with that in the next few years. I actually think we should be abandoning vol and looking at underlying holdings analysis. And private equity is a lot more risky than volatility gives, but that's another discussion. But again, and then on the planning side, it's not enough to look at a portfolio. You've got to start with the whole client, the whole balance sheet, the tax profile, and then all those things we do know: the portfolio, the risk profile, the generations, the insurance, all. So you really are saying, I'm going to, instead of a kind of a 2-year apprenticeship to get going, you're really looking at a 5 to 7 year, because the biggest thing occurring is the capital coming from the parents, the baby boomers, down to that next generation who are in their 30s and 40s. And the needs of those clients is going to be, more sophisticated, particularly if there's more capital. So it's a great opportunity, but it's more, you wouldn't want a doctor who got an education in 1 year, right? And is out with a scalpel. So I think we're going to have to see that dual designation and then more years. We need a lot more mentorship in this industry as well, where these people are coming in and they're working with senior people who are used to the complexities, particularly in the more affluent segment of the market. But a great opportunity. I mean, you're investing in yourself and your own knowledge. You really are the product, both because there's an emotional IQ side to this business, right? Now, it's not just intellectual IQ. There's a work ethic side because you have to work hard. And with this constant change, it's always creating opportunity, but you have to like a pretty good pace of work to be truly successful with your clients in this industry.
If I could pile on as well to this mentorship comment, which is a really powerful one. This is an industry where you need to live through a few tail events, and you need to see people, because it's hard to read about them until you feel them, until you're in a .com crash or a 2008 cliff or COVID. These are the times where it goes beyond academic to, you learn a lot during those periods. You learn a lot about yourself. You learn a lot about your clients. You learn a lot about your colleagues as you navigate those things.
Well, yeah, you also learn whether you actually got your clients prepared enough for it.
Right.
This goes back to my comment on our clients in 2007. We only had a couple. We were just getting rolling. And so in our investment policy statement, we have always taken the projected asset class, Canadian equities, U.S. equities, and you got bonds, whatever. You got pretty good data on all the major asset classes all the way back to the early 70s. So we'd run a back test of the asset class. We're not saying anything more than this is a risk assessment tool. We're not saying it will happen. We're not saying anything about expected returns. It's a stress test. And we show clients, well, with this portfolio, you can have a fairly growthy portfolio, let's say. You can have a 35% drawdown in a severe market test, not a standard. What we're talking severe event. They what? And we of course were showing them the oil crisis of 73, 74, which was a vicious bear market running across several years. You thought you're out of it. Thought I wasn't in the industry. I just graduated. I was just lining up, with my Mustang trying to get gas for my car. But and I remember one client saying to me, I'm, right at the great financial crisis, because we had always said, if you can't stay invested in this kind of event, let's discuss a lower risk portfolio. And so when the great financial crisis came, the numbers are pretty similar, right? It's like 50% decline in equities, that kind of thing. And they said, well, you told me this could happen, so I wasn't surprised.
There you go.
We stayed invested.
Perfect.
And we by the way, we never say staying invested is guaranteed. We say there's 200 years of capital market history that argues that case. But, if you're going to articulate reality to your client, that's what we all count on. And we account the fact that all the stakeholders want economic growth and prosperity. Even the dictatorships want their people reasonably prosperous, because that way they're more docile. So, whether it's the government, the business people, the labor, we all have a vested interest in, coming out of business cycles. And fortunately, we've built the tools. One of our things in our IPS, we've always said, is our IPS excludes catastrophic risk, because in the Great Depression, stocks dropped 80%. But we were always of the opinion that, that was a failure of allowing money supply contraction and the failure of the banks, and that the monetary authorities would not allow that to occur. And Bernanke, who, is an expert in the Great Depression, did not fail us, although we had a lot of work to get the political side on side. So that's where the history comes in, right? So we also had in our IPS early that this may not apply if there's a pandemic.
Oh, really?
Now, this last, one client called me and said, you said this kind of thing could happen. I said, well, go to 57, go to 1917. Oh, but, it ends differently, because the miracle of modern, we had reasonable solutions on a vaccine side in a matter of months. I mean, they've been under work for years, but, the response by the government, the funding, rather than 4 or 5 years. So I'm not sure we learned a good enough lesson. We learned that there's a solution that comes out fast. Sometimes it's not going to be a solution that fast. And we may be into that 73, 74, where it's a couple of years of, getting your clients ready, being the long-term, staying invested is critical. Yeah, but the value is all in the planning, because it's really, they've got to make that decision before the event, not during the event, because otherwise you turn what's historically been a temporary decline into a permanent loss by selling out at the wrong time.
Exactly. And I think this is your benefit of being a historian is, we don't know when these events will happen, but we do know they will happen. And so there's nobody who can say there's not going to be that kind of an event in the future. Now, will it be next year, 5 years, 10 years, 20 years?
That's by the definition of, tails, they appear at an unforecastable. But we've now seen, we face perilous risks, what happens in terms of an invasion of Taiwan, with the whole chip industry, so focused out of there. What does that mean? Would people reinvest just because there's a monetary spur? Because that has, that may have growth ramifications for 3-4 years of negative GDP. You get into these things. So the key is getting the client aware that there's going to be these very challenging periods, and they should make the decision on their asset mix. That's why one of the next evolutions is, as you know, two elements of risk. One is the drawdown and the ability to stay invested. The second is, will it create enough capital for me to retire on reasonable terms? And there's trade-offs, and the industry doesn't deal with that yet. That'll be, you walk ahead 10 years, I'm sure the commissions may require shortfall risk assessments on clients.
Interesting. Yeah,
right.
That makes a lot of sense. Michael, I could keep you another hour or so. I think we should probably start bringing it to a close. Before I do that, is there any area or insights we didn't cover that you might want to share?
Oh, I don't think so. It's pretty far ranging.
It was indeed. I really, really enjoyed it and appreciate you doing this. I follow you through Tacita. If people want to stay connected and kind of hear your perspectives, you do periodic writing for the Investment Executive and other publications. How do we find you if people are interested in following?
You can go to our website, and in the bottom of the page, Tacita Capital Insights, you can sign up, and we're distributing various pieces pretty regularly. We also have a lot of people we have a monthly piece that summarizes all the returns by market, by factor. It includes private equity, real assets. Once a month you get a comprehensive view, and it's both the current, goes back 20 years. So that's a piece that we found even a lot of people in the industry because we're on, in terms of going to LinkedIn, we're posting all the time.
Fantastic. Michael Nairne was the guest. Michael, notwithstanding your modesty, you're a giant in the industry. You've had a real big impact on many, myself included. So thank you for that. And thank you for all these incredible insights. We really appreciate your time.
Thank you for the opportunity to chat. We really enjoyed it.
Great stuff. Weekend. Thank you. You too.